about 1/3%. We're seeing gold down 2.25% to the downside. It might end up having an expansion move to the downside to go down towards the 50-day moving average potential. We'll have to see how this shakes out. We may see the precious metal space, it is set to gap lower, gold, silver, and miners, and the stock market is set to gap higher. So we might see kind of an exhaustion move, meaning all the metals space gaps lower and then starts to rally back, and we see all the equities, all the stocks gap higher.
The way we need to look at it, in my opinion, is that the price of gold and silver are only a reflection of the health of the fiat currency system. And I'm going to show you some charts that will make you shocked.
The recent market action reveals a compelling divergence between equities and precious metals. Stocks continue to surge as optimism drives capital into risk-on assets, while gold and silver experience sharp corrections. This inverse movement is typical in short-term cycles where liquidity seeks quick returns. Yet, beneath this enthusiasm, concerns about sustainability linger. The volatility in gold sliding over 2% signals deeper anxiety about fiat stability rather than mere technical weakness. Markets may celebrate rising equity values, but seasoned investors recognize that such moments often precede correction phases. In this environment, gold and silver act as more than commodities. They mirror the confidence, or lack thereof, in global currencies. The drop may appear discouraging, yet it reflects the tension between speculative momentum and monetary reality. Historically, when precious metals gap lower as equities gap higher, a reversal often follows once the emotional imbalance corrects itself. What if this current move isn't weakness, but preparation for a powerful recovery phase? The answer may lie in observing how investors react once the euphoria fades and the dollar's underlying fragility re-emerges. Physical ownership remains an essential safeguard. Unlike paper assets, tangible gold and silver preserve value when digital wealth fluctuates. The physical bar and historical coins embody monetary integrity that cannot be printed or replicated. As global currencies lose purchasing power, some down more than 99% over decades, precious metals remain the constant benchmark. This isn't just about market timing, it's about understanding the long arc of monetary decay and positioning accordingly. Whether or not this current decline extends further, the long-term trend remains anchored in the reality that gold and silver ultimately outlast fiat illusions. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Taking a look at the charts, we've got equities trading sharply higher up this morning. We've got the NASDAQ up 1.3%. If we take a look at the NASDAQ futures, nice pop there, gapping up. Not a big fan of gaps to the upside when we're in an uptrend because they generally like to backpedal and fill, fade back in and fill before they want to go higher. We're getting a little extended from the 5-day, but overall, the market continues to want to run higher. If we take a look at the S&P 500, it is up 0.8%. And if we look at the Russell 2000, it is also up 1%, testing some highs here. So definitely money piling into the risk-on assets, moving into equities. We are seeing it move out of the risk-off assets, which are bonds. Bonds are down about 1/3%. We're seeing gold down 2.25% to the downside. It might end up having an expansion move to the downside to go down towards the 50-day moving average potential. We'll have to see how this shakes out. We may see the precious metal space, it is set to gap lower, gold, silver, and miners, and the stock market is set to gap higher. So we might see kind of an exhaustion move, meaning all the metals space gaps lower and then starts to rally back, and we see all the equities, all the stocks gap higher, and they start to pull back to fill those gaps. So we might see a little bit of a short-term pause or pullback in the equities market while maybe the precious metal space starts to get a bid again. But right now, we do have fear carrying over from the recent drop in the price of gold, silver, and miners, and that is carrying over to today. And people, I think, are set to kind of get spooked out today at the open.
Mainly because we've seen a big pickup in the price of gold and silver. But the way we need to look at it, in my opinion, is that the price of gold and silver are only a reflection of the health of the fiat currency system. And I'm going to show you some charts. Bulk of your gold, as I said, needs to be, and silver needs to be physical. This is a 50 troy ounce Engelhard silver bar. I've had this for a long time. I mean, it's $2,500 now at 50, roughly 50. A few years ago, silver was still at 20. It was 1,000, so it's done quite well. The same thing goes for gold. You need to hold the physical. Here I've got a $20 gold piece, double eagle. The dollar has gone down 99% versus gold, versus real money, and the chart is the line that measures the dollar here is going almost off the charts, but to the downside. I think what we will see is an apocalypse. People are going to realize that these fiat currencies are worthless, and they will want gold. And I think the central banks know that already, and they're very wealthy, and that's why they're buying physical gold and silver hand over fist. So this is not just a dollar thing. So we'll go step into the realm of the euro. And I guess they can do the euro back to 71, because the euro is just a basket of the old legacy currencies that were fixed at a certain rate in 1998 or 99. I'm not too sure what year it was, but it was thereabouts. So the euro hasn't done much better. It's down 99%. I would say, though, if you looked at the Deutschmark separately, it would be down a little less. So all the other currencies have diluted the Deutschmark, but it's the same story here with the euro. And many people think the euro is going to collapse first. I don't know, or the yen, but I think in the end of the day, it doesn't matter which one collapses first or last. The thing that you need to have is gold and silver. And we're going to look at a chart of silver for the US as well. So this is the British pound. It's the same story. Down 99%.
Global markets are witnessing a sharp divergence between equities and precious metals. Equities, led by the Nasdaq and S&P 500, continue to rally as investors pour into risk-on assets, while gold, silver, and bonds experience a notable pullback. Such moves, though dramatic, are typical in late-stage bull markets, where gaps to the upside often invite short-term corrections. As equities extend gains, metals and miners gap lower, reflecting short-term fear and profit-taking among leveraged traders. Yet, this volatility may mark exhaustion rather than reversal. The broader market dynamics suggest a potential rebound in precious metals once equities pause to fill their gaps. Despite the short-term weakness, gold's technical structure remains supported by long-term demand and its historical role as a hedge against systemic fragility and currency debasement. Beyond the daily fluctuations, the deeper truth lies in gold and silver's reflection of fiat currency health. Over the past century, the dollar has lost 99% of its purchasing power relative to gold, and similar declines plague the euro, yen, and pound. Central banks and wealthy investors are accumulating physical gold and silver, anticipating the eventual collapse of over-leveraged fiat systems. As currencies erode and inflation persists, physical ownership, not paper claims, remains the ultimate safeguard of real value and financial sovereignty.
If we take a look at the US dollar index, we've got the dollar trying to carve out a bottom here. It's had a pretty nice run to the upside, a fairly controlled pullback, and you could argue this is kind of right through a fairly critical level on the chart. Obviously, there's some other highs that I'd like to see broken through here, but overall, there's this big rounding potential bottom forming, and it does look like it's turning from a set of bearish chart patterns to now it looks more so a bullish chart patterns, pointing to this eventually should work its way up and to the right, which typically means the equities markets might be struggling and start to move lower over the next couple of months. Again, we look at this pattern, this still could take a month or two to potentially finish unfolding before we start to see it have a leg higher. Of course, if this starts to go higher, eventually we'll see probably precious metals want to pull back if the dollar continues to strengthen. But we'll just have to play one bar at a time. There's no point in trying to front run and guess what's going to happen. We just follow price If the markets are up, we're long, and if they show the strength, if they're not and they're showing weakness, we don't want to hold that asset, whatever it is. When we step out back and take a look at the big picture, just a high level view, this is our TTI, our technical investor strategy, tells us when we are in a bullish environment, when you want to naturally be long equities. If I can get this to draw here. Here we go. When we're naturally long, when we want to avoid the markets and step aside, when to be long, when to avoid. And so we last two pullbacks here was the 2022 bear market telling us to step aside, move to something else. And then eventually we had this very nice run to the upside. Then we had the recent tariff shake up here in the markets in terms of trying to figure out which way the markets are going. And we're back into another bullish environment. So when you step back, we're still, I wouldn't say it's a fairly strong bull market. But underneath the hood, it's not everything blazing on all cylinders and taking off. The stock market, as we've seen from our sentiment charts, show that the market isn't all that strong underneath the hood. It is trending up. You got to be, long the markets if it is trending up and it meets the long-term and the short-term criteria. But you definitely don't want to be betting against it. Eventually, it will have a big pullback.
Well, here I have the Indian rupee. According to this chart, it's down 100%. Is it any wonder that the RBI is now accepting silver as collateral for loans and gold? For all intents and purposes, the Indian rupee is toast. And the same thing goes, believe it or not, for the Chinese yuan. It's down 100%. Is it any wonder that the Chinese leadership has encouraged or is encouraging its citizens to buy gold and silver, because they know their currency and all other fiat currencies are nothing but toilet paper, even worse than toilet paper, I would say. So let's go and look at how. I'm going to go through the process here so you can do it yourself. I'll show you how it works. So you scroll down here. Yes, silver has underperformed, but still the dollar's down 97% versus silver. So there you go. I'll stop sharing now. What else did I want to cover today? Another chart that I wanted to cover today is this one. And I've been showing this for a while now, and I call it a disturbing resemblance. I'm going to try to make it bigger here. And the chart on the left is the value of one gold mark, the coin, gold mark, in paper marks. And up until the beginning of World War I, of course, the mark was as good as gold, but unfortunately wars push countries into going off gold or cheating their citizens and paying them with paper. And it took a while for the paper mark to really get trashed. And of course, this is in terms of how many ounces you can get for a gold mark. And you can see that up until the middle of 2022, it wasn't that bad. I mean, we went from somewhere around 1 to around 100. And you might think, well, that's a lot, 100 times. But don't forget, we've gone from 35 in 1971 to now over 4,000. That's like 100. I know it's been over a longer period of time, but it's similar. It's very similar. It's a matter of fractals.
The US dollar index appears to be forming a rounded bottom, suggesting a shift toward bullish momentum. If this continues, equities may weaken, while precious metals face temporary pullbacks as a stronger dollar often pressures gold and silver. Analysts emphasize reacting to price action rather than predicting it, given uneven market strength. Meanwhile, global fiat currencies show deep deterioration. The Indian rupee and Chinese yuan, both sharply devalued, have led governments to accept gold and silver as collateral and promote them for savings. Could this renewed focus on tangible assets signal an approaching monetary reset? Historical parallels, such as Germany's papermark collapse, warn of the consequences of debt and unchecked money printing. Across time, currencies fail, yet gold and silver endure as stable stores of value. In an era of weakening confidence in paper money, these metals remain vital hedges against monetary decay, inflation, and the erosion of trust in financial systems. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates.